So Sam Darnold, the Super Bowl winning quarterback of the Seattle Seahawks, is going to end up paying more in taxes than he earned winning the Super Bowl. How's this work? Well, California has something called a jock tax, and Sam's incentive for winning the Super Bowl was a bonus payment to him of about $178,000. Yet the state of California is going to be coming after him for about $250,000. So the way that this works is Sam's going to make over $100 million in his 3-year contract, and California, through their jock tax, is going to look at the number of days that he spent working in California, not just game days, but also practices or away games or the other days where he's there providing services in preparation for the Super Bowl. And based on the number of days that he's there, they think that they're entitled to collect a portion of his overall earnings. And California is one of the few states that imposes a tax like this. So it's a real problem for the NFL and the NFL Players Association when they host the Super Bowl in a state like California, because it ends up costing their players so much more money. So the way that this works is the state of California counts what are called duty days. And because Sam arrived in San Francisco 8 days prior to the Super Bowl, they count each of those as duty days in preparation for the game and in actually playing the game. And if you start to add in other days that Sam has spent there over the life of his contract or in any tax year with away games, or maybe he was there for other maybe sponsorships or meet and greets and things like that, state of California imposes this jock tax simply because he's working in the state of California. Now here's the good news for Sam. In addition to that bonus of $178,000 he gets from the NFL, chances are the long-term exposure that he got for being a Super Bowl winner and the additional sponsorship opportunities, he's going to end up making more money from this, but that's a big chunk of change that he's going to have to pay to the state of California. And while the jock tax really only applies to professional athletes, this is something that business owners need to be aware of, not because of the jock tax, but because if you've got employees or sales in other states, or if you've got physical property there, you may end up having to file state taxes and paying state taxes in multiple states. So this is a really important element of your tax planning, because you want to make sure more of your income is allocated to the low income or no income states and not those higher income states like California.